Hello, my dear students. So, I am coming up with the new topic, irrecoverable debt. So, let us understand the concept of irrecoverable debt. Before doing the question, let us quickly understand the concept of irrecoverable debt. What is irrecoverable debt is all about? Okay. So, irrecoverable debt means what? Whenever a business entity sold goods on credit to a customer, there is always a risk that that money may not be recovered, right? So that risk is called as risk of irrecoverable debt. Irrecoverable debt is a loss to business entity, right? So what is irrecoverable debt? Irrecoverable debt, as name itself suggests, irrecoverable means not recovered. Debt means the trade receivable to whom we sold goods on credit. So irrecoverable debt is a loss to a business entity. Whenever a business entity sold goods on credit, there is always a risk associated of non-recovery of amount due to the credit customer. So whenever we sold goods to customer on credit, so that person is called as trade receivable. The person to whom we sold the goods on credit is called as trade receivable. For example, if I sold goods to Mr. Ram on credit for $1,000, so Ram is my trade receivable. So entry will be Ram account debit, sales account credit. So whenever I sold goods on credit, that means the amount will due in future, that will received in future. So that risk of non recovery, if amount does not recovered in future, then that risk is called as irrecoverable debt. If any amount due from trade receivable not recovered within reasonable period of time, what is reasonable period of time? The credit period. For example, if I sold goods to Ram and asked him to pay within 10 days, so that 10 days is the reasonable period. If this does not recover within reasonable period of time due to any reasons like insolvency or bankruptcy, these are the two technical terms that will be used in the question. So this insolvency or bankruptcy, whenever they says Mr. Ram become bankrupt, that indicates that that amount is not recovered or that will not be recovered. So at that time we will recognize the loss. That loss is called as irrecoverable debt. So such amount will be treated as irrecoverable debt. Let us take an example. Say Mr. Ram sold goods to Mr. Hari. So can I say Mr. Ram is called as seller? So to whom the risk of irrecoverable debt happened? So Mr. Ram is a seller. So seller is always having a risk of irrecoverable debt. So Mr. Ram, let us understand. We are Mr. Ram. Mr. Ram sold goods to Mr. Hari. So can I say Mr. Hari is my credit customer? That is buyer. He is my credit customer for Ram on credit for $10,000 on 31st August. So at the time of sales, we will recognize the revenue. What entry will pass? In the books of Mr. Ram. Sorry, it's not Hari. In the books of Mr. Ram, because Ram is the seller, will pass a journal entry. Hari account debit, sales account credit. Hari account debit, sales account credit. So this Hari is my trade receivable. This Hari is my trade receivable. जिसे मैंने उधार पे गुड्स सेल किया है, तो वो जो पर्सन है जिसको मैंने उधार में सेल्स किया है उसे बोलते हैं ट्रेड रिसीवेबल. सो ट्रेड रिसीवेबल इज अ पर्सन टू whom goods are sold on credit. As per principle of realization, since we are sold, we have transferred the title of goods, we have to recognize the revenue. So sales account is credited, that means revenue is recognized. So what will be the narrative? Being goods sold on credit to Hari. Now Hari is my trade receivable. That means the money will be received from Hari in due course of time. Now, what question is saying? On 31st December 2023, okay, Mr. Hari declared bankrupt. That means now this is an indicator that money will not recovered. So we as a business we have to recognize the loss in the books of Mr. Ram. And what will be the entry? On the date when we realize that this money is a loss, this money will not come back. On 31st December 2023, we will pass entry irrecoverable debt account debit, Hari account credit. That means what do you understand by this? By the irrecoverable debt, can I say Hari was debited when it is a sales? And when we write off the loss, Hari is credited. That means we have closed the account of Hari. Hari account is debited and Hari account is credited. Money does not received, so we have written off with the loss. This loss is called as irrecoverable debt. So what will be the narrative? Being irrecoverable debt written off. Now, let us understand with the help of trial balance. Say in example number 2, in the books of Ram, we have trade receivable of 10,000. We have also given irrecoverable debt of 200. Now, irrecoverable debt which is given in trial balance suggests that this irrecoverable debt has already been adjusted from trade receivable. That means this is an irrecoverable debt coming after adjustment of account. That means this has already been recognized as a loss. And then we have given the allowances for irrecoverable debt 800. Now, allowances for irrecoverable debt is based on principle of prudence. Irrecoverable debt is an actual loss, but allowances for irrecoverable debt is a possible loss, that is probable. Future liability can arise if money does not received. So sometimes it may happen that my customer, credit customer, does not bankrupt or insolvent, but there is a higher chances or higher probability that money cannot be received. Money will not be received. There is a higher probability. There is a higher probability of loss. Now, in that case, when there is a higher probability of loss, the principle of prudence says that you should recognize the loss in current period only. Don't wait for future year. The losses should be recognized in current year only, but future year income should not be recognized. Right? So principle, as per principle of prudence, we are making allowances for irrecoverable debt. So in trial balance, allowances for irrecoverable debt, $800 is already given. Additional information. Additional information is given to us that says further irrecoverable debt is $500. Now please be careful students, please concentrate. Irrecoverable debt is also given in trial balance, and in additional information irrecoverable debt is also given. What is the difference? The difference is the irrecoverable debt which is given in the trial balance is already adjusted, means from 10,000 this 200 has already been write off. But when it is given in additional information, that means this journal entry is required to be passed. Right? So we have to pass a journal entry for further irrecoverable debt. That entry will be irrecoverable debt account debit, trade receivable account credit. So can I say my irrecoverable debt after passing this entry becomes 700? Because this 500 plus 200, it becomes 700. And my irrecoverable trade receivable will be reduced by from 500. So after passing this journal entry, the balances of trade receivable and irrecoverable debt will change. And point number 2, we have given allowances for irrecoverable debt is to be calculated at 10%. Now, student, please understand. Allowances for irrecoverable debt is an estimated account, right? It keep on changing. This is an accounting estimate. It keep on changing every year. In last year, I thought that 800 may be loss, but in current year, I am calculating at the rate 10%. That means I have to again recalculate on the basis of closing trade receivable, because it is not actual. It is a provision based. Provision means the estimated provision, estimated calculation of data. And in accounting, estimating is allowed. You can estimate the future liability, and accordingly you can recognize either income or loss in current period. Don't worry, we'll understand with the help of question. Now, you are required to prepare past journal entry of irrecoverable debt, calculate revised trade receivable. Sir, why we are calculating revised trade receivable? So that we can come to know the closing trade receivable balance. Calculate closing allowances for irrecoverable debt, show the effect of increase or decrease in allowances, and then prepare the financial position. I'm quickly take you to the journal entry. What will be the journal entry? Irrecoverable debt account debit, trade receivable account credit 500. Sir, which 500? The further irrecoverable debt. Sir, why we have not passed the journal entry for 200? Because it is already been adjusted. I hope now you understand. So those irrecoverable debt which is given in trial balance, no need to pass journal entry, because it comes in trial balance because its ledger has already been prepared. And how we have prepared the ledger? By passing the journal entry. So that means that irrecoverable debt which is given in trial balance is already adjusted. But irrecoverable debt given in additional information, we have to pass the journal entry. So we have passed the journal entry of irrecoverable debt account debit, trade receivable account credit. Important note, irrecoverable debt appear in trial balance is already recorded. Trade receivable appear in trial balance is arrive only after adjusting irrecoverable debt appear in trial balance, that is 200. Key concept, trade receivable $10,000 is an amount come after deducting 200 which is appear in trial balance. However, further irrecoverable debt need to be adjusted from trade receivable as it is obtained revised trade receivable. So what will be my revised trade receivable? Trade receivable minus further irrecoverable debt, that is 9,500. Now we will understand how to present in the ledger. So we have to prepare three ledgers, guys. First, trade receivable account. Second, allowances for irrecoverable debt account. And third, we have to find out how to present in statement of profit and loss. And fourth, how to present in financial position. If you are able to understand this concept, the question will become very easy for you. So let us understand. Now, when we are saying trade receivable is given to me, the opening trade receivable, let us go to ledger. This opening balance is 10,000 given to us. So can I say the opening trade receivable is always on debit side? Why, sir? Because trade receivable is my current assets and opening balance of current assets is debit. What is the balance of irrecoverable debt? Sir, irrecoverable debt is an expenses. So expenses is also having a debit balance. So it is also having a debit balance of 200. So in irrecoverable debt account, it will also 200. So in irrecoverable debt, it is 200. Since it is an expense, we have to directly put into the profit and loss. Then allowances for irrecoverable debt balance is given as how much? 800. Now it is given in the credit side of the trial balance. So allowances for irrecoverable debt will also come on the credit side. The opening balance is credit, right? In between, I have given the explanation of all the calculation. Now we have to pass an entry for further irrecoverable debt. So entry will be irrecoverable debt account debit, trade receivable account credit. So I get the revised value of trade receivable, that is 9,500. And this 9,500 will again become the opening balance. When we are talking about allowances for irrecoverable debt, 800 is already given, but we have to calculate the closing allowances. Now this is important, students. How to calculate closing allowances? So closing allowances, write down the formula. It is always trade receivable, the closing balance of trade receivable minus further irrecoverable debt. Further irrecoverable debt. This is important. And then apply the percentage given. So can I say my trade receivable is given as 10,000? I have to reduce further irrecoverable debt. So further irrecoverable debt is how much? 200 or 500? The further irrecoverable debt is 500. 200 is already adjusted, right? From 10,000. So we have to adjust only 500. So 10,000 minus 500. And the question says that provision or allowances for irrecoverable debt is to be created at the rate 10%. It is given at the rate 10%. 10% is given. So the closing allowances for trade receivable will be 10%. So multiply by 10%. So this is how we will get the closing allowance. Now if you see, guys, opening allowances is given as 800 and closing allowances is given as 950. So that means the balance comes 150 on credit side. So whenever the liability increases, how liabilities increases, sir? My closing liability is 950 and my opening liability is 800. That means my liability is increases by 150. And whenever liability increases, it is a loss to business. So what we will call this as what we will call 150 increase in liability, that balance is called as expense for the business. So whenever liability increase, it is an expense. Sir, can allowances be also converted into income? Obviously. For example, if 800 is the opening balance and say closing balance is 750. So in that case, my opening liability is 800 and my closing liability is 750. That means my liability is reducing, right? So allowances is not the actual loss. Allowances is the possible loss. So it may change. It can either convert it into loss, it can either convert it into income. So in this example, you see that the liabilities increases. That's why this 150 is treated as expense. If the liability reduces, it will be called as income. Now, in statement of profit and loss, how we will show? In expenses, first we'll write irrecoverable debt. So opening irrecoverable debt is given as 200. The additional irrecoverable debt is 500. So my total irrecoverable debt is 700. And then second is my future loss. Future loss, as per principle of prudence, we are allowed to provide it for future losses, and that future losses is called as increase in allowances for irrecoverable debt 150. I hope this is clear to you. Sir, what if my liability reduces? Then it will go to income head in a statement of profit and loss. Now, how to present in the financial position? Under the current assets, trade receivable is 9,500, and then 9,500, how will get 9,500? This is the closing balance. After closing balance after further irrecoverable debt. So now my current trade receivable is 9,500 because out of 10,500 is already been recognized as a loss. So my current trade receivable is 9,500 only. Now, this in financial position, I will write 9,500. Why, from this trade receivable, this is important. Huh? How to show allowances for irrecoverable debt. From trade receivable only, the closing allowances for irrecoverable debt will be reduced. And then we will show the net value. Always remember, use second and third column because the first cost and accumulated depreciation and net book value is all only and only for non-current assets. Am I clear, my dear? You understand the point or not? So 9,500 minus 950, 8,550 is my net, that the closing trade receivable. This is how we are going to show. So what is irrecoverable debt? It is a loss to business. That amount owed to the credit customer is not recovered back due to insolvency or bankruptcy. And in that case, whenever we realize that it is an irrecoverable debt, we have to recognize into the accounts. Clear? Chaliye ji. So this is the concept of irrecoverable debt. Now we are moving to a question for your more clarity. Irrecoverable debt. So let us do one question. Adil, if you need the PDF of this notes in the comment box, please write notes. I will share you. I will DM you in your inbox or share your email ID. I can also email you. Coming to question number one, everyone. Adil is a wholesaler. All his sales are made on credit terms. All his sales are on credit terms. His financial year ends on 31st August. This is very, very important. Financial year ends on which date? 31st August. You are required. State the meaning of each of the following terms. Irrecoverable debt. Now you see, student, for 1 marks, they can ask the definitions, right? So what is irrecoverable debt? You can write it down. Irrecoverable debt means what? You can pause the video, write it yourself, and then see the answer. So what is irrecoverable debt? Irrecoverable debt is a loss to business. It is a loss to business. It is a loss to business as money owed from credit customer does not recovered due to insolvency or bankruptcy. due to insolvency or bankruptcy. Now, coming to next point, irrecoverable debt recovered. Now, this is a unique point. If I already write off my customer's account with irrecoverable debt, in our example, Hari account was closed. Now, after some times, in my ledgers, there is no Hari now because I have already written off the Hari account. Now, after some time, Hari comes to me that your money is due last year. So in my mind, I have a thought that Ari account is already been closed, but that doesn't mean that money I am not asking for. You understand my point? Money is still due. In my accounts, I have closed the account, but in reality, that money is due. So when Hari pay me the amount, I will pass a entry bank account debit, irrecoverable debt recovered account credit. I will not credit Hari account because Hari account is closed with irrecoverable debt. So many students make mistake in this entry. They will write bank account debit, Hari account credit. Array Hari account is already closed. It has been already been written off. That's why we pass the journal entry irrecoverable debt. So those money which is already been written off as an irrecoverable debt, and in future if it comes back, it is called as irrecoverable debt recovered. So you can write the journal entry for irrecoverable debt. Here it is only asking the meaning, but for your reference, please write the entry also. Bank account debit, irrecoverable debt account credit, irrecoverable debt recovered, irrecoverable debt recovered. Yes, irrecoverable debt recovered account credit. Don't write irrecoverable debt, right? So irrecoverable debt recovered. This particular term is important, recovered, because irrecoverable debt is a loss and irrecoverable debt recovered is a income in the year in which it is received. So what is irrecoverable debt? So write it down, guys. Irrecoverable debt means money due to money due which is written off as which is written off as irrecoverable, which is means money due, the money which is due, which is written off as an irrecoverable debt in previous year, written off as an irrecoverable debt in previous year, is recovered back, is recovered back to business. So the money which is already been written off as an irrecoverable debt, जो पिछले सालों में मैंने पैसा डूबा हुआ मान लिया था, तो वो तो अकाउंट क्लोज हो गया, बट वो पैसा जब वापस आया, when this money recovered, it is an income for the business. So what is irrecoverable debt recovered? Those irrecoverable debt which is already been write off, now recovered, is called as irrecoverable debt recovered. Now, the third point, provision for doubtful debt. Now, the previous name is provision for doubtful debt. Now, the terminology changed. Now, it is called as allowances for irrecoverable debt. Either of two terms can be used, but I have put a slash in between so that you will identify. If any term come, you can understand. Provision for doubtful debt or allowances for irrecoverable debt. So what is allowances? It is a possible loss. It is a possible loss. As per principle, now allowances is prepared as per principle of prudence, and irrecoverable debt is recorded as per principle of matching. So student, I will upload one video on accounting principle only, where you will understand all the accounting principle at a single in a single video, right? So whenever we prepared provision, whenever we prepared provision, uh, it should be based on principle of prudence. So write it down. What is provision? It is an estimated. It is an estimated. It is an estimated amount. It is an estimated amount. It is an estimated amount of probable loss. It is an estimate amount of probable loss due to irrecoverable debt. देखो, Language can be changed, but the essence of words should be same, right? You may use different language in different author, they may use different language, but the essence of concept should be same. It is an estimated amount of probable loss due to irrecoverable debt. And since this is an estimation, it keep on changing every year, right? On 31st August 2018, on 31st August 2018, Adil received a check of $0.20, right? 0.20. So $1, when it is in the decimal, it is called as cent. So 20 cents or $0.20. Can I say 20% in a dollar? 20 cents in a dollar means 20% in a dollar. From Mahindra, a credit customer, the balance of amount was irrecoverable. Okay. So the question is starting with an information that we have one customer called as Mahindra to whom the amount is due. He only paid 20 cents in a dollar. That is, can I say the 20% only? And what about the 80%? What about the 80%? The question says it is not due. The question says 20% is received from credit customer by way of check. That means it is received. But what about the balance 80%? The question says the balance of the account was irrecoverable. So 80% is my irrecoverable debt. Okay. So for example, if Mahindra we owe $1,000, so 20% means we have received only $200 and remaining $800 is irrecoverable debt. But we have to see the information in the question how much is due. So the question is given required information. Record the information in following accounts in Adil's ledger. Close the account on 31st August 2018. Okay, by balancing or by making a transfer to an appropriate account. Some entries have already been made in accounts during the year. So can I say in the books of Adil Mahindra account? So Mahindra is my trade receivable, is my credit customer whose account is given to me. This credit customer is also known as trade receivable. This is also known as trade receivable. Now, on February 1, 18, we have made the sales of 600. So what will be the entry? Mahindra account debit, sales account credit. So in ledger account, sales account is on the debit side of Mahindra. And on February 10, Mahindra returned the goods to us, sales return. So can I say technically sales is of 600 and $30 is returned. So how much balance is due? Can I say $570? Yes or no? We have made the sales of $600. Out of this, $30 has already been returned to us. So can I say Mahindra is liable to pay only 570? You understand the point or not? But the question says we have received only 20%. So please calculate, my dear. 570 multiplied by 20%, how much we have received. Please calculate with me how much we have received. 570 multiplied by 20%. You may please use the calculator. 20%. So can I say $114 I have received? Sir, what about the balance money? It is irrecoverable debt. Oh, so 570 into 80%, 456, my account will be closed with irrecoverable debt. My means the Mahindra's account. So what will be the entry? The entry will be bank account debit. So I am writing journal entry first. So what will be the entry? Bank account debit. Bank account debit $114. Irrecoverable debt account debit because it is a loss and losses will also debit. Irrecoverable debt account debit. How much? 456. And Mahindra account credit. Mahindra account credit with how much? How much? 570. So can I say my Mahindra account will be closed? So what will be the ledger posting? What will be the ledger posting on 31st August? I will write what? Bank account where I will receive only how much? 114. And this 456 is not balanced because Mahindra is unable to pay. That is, so we have to recognize the loss, irrecoverable debt. August 31. And this irrecoverable debt will be transferred to statement of profit and loss. So can I say Mahindra account is now closed because the balance money will not receive to us. Is this clear or not? Now, coming to irrecoverable debt account, can I say the opening balance is already given till 30th August 2018? They said, sir, till 30th August, we have this amount of irrecoverable debt already been adjusted. Now we have further irrecoverable debt of 456 from Mahindra. So can I say on August 31st, I have to write what? Mahindra irrecoverable debt account. This is just a double entry. This is just a double entry. Mahindra account 456. So what is the total? What is the total? 1156, I think. 1166. 1166. Can I say this 116 will be transferred to statement of profit and loss? Because all the losses and expenses finally transfer to statement of profit and loss. So statement of profit or loss. This 1166 will be transferred, right? This 1166 will be transferred to statement of profit and loss. Now, Adil is proposing to stop selling on credit. Now, Adil is saying, boss, I'm done with the credit sales. Now, Adil is proposing that let us stop credit sales. And why is thinking so? Because there is a higher risk of irrecoverable debt. He already incurred the loss of $1166, and he is thinking to sell on cash terms only. So he says we are stopping the credit sales. But when you're taking any decision, there will be an impact. So question required. C point. State one possible advantage. So he is asking for advantage to Adil of going ahead with the proposal. So the question is asking to you, give the proposal to Adil, give one advantage. If Adil decided to selling on credit, stop selling on the credit, what will be the advantage to him? So you may please pause the video and think of yourself and then replay the video, right? So state one possible advantage to Adil of going ahead with the possible proposal. Right. So can I say if he stops selling on credit, his risk of irrecoverable debt may be eliminated? Because when you are selling on the cash, there is no risk that money will come or not because it has already been received. So what is the possible advantages? The possible advantages would be risk of irrecoverable debt. Risk of irrecoverable debt can be fully eliminated. Eliminated means reduced or minimize or can be over. So risk of irrecoverable debt can be fully eliminated, can be avoided, right? This is the advantage. Point number two, and since there is no loss of irrecoverable debt, your profit can be increased. Point number two, state one possible disadvantage if Adil is going ahead with the proposal. So what will be the disadvantage? You may please think, pause the video. Huh? Now, come back. State one possible disadvantage of Adil of going ahead with the possible. What can be the disadvantage? Hmm? What can be the disadvantage? If I stop selling on credit, can I say the customer may shift to the different competitor? This is they can ask to Adil that Adil, from last so many years you are giving us credit and suddenly you stopped giving us credit. So there is a relationship between the customer, between the supplier and the customer. So if you suddenly stop any of the scheme or any of the policy you have, then it might happen that some of the customer who may get credit from different supplier, they may shift, right? So in business it happens. So there is a risk that your customer base may be shift to your competitor, right? They can say, okay, if Adil is not giving, we are allow you the credit. So they might be shift. So this is the possible disadvantage. So write it down. Existing customer, existing customer may shift to competitor, shift to competitor, 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 oblique, supplier who is dealing with the who is dealing in the same goods may shift to competitor or supplier, which may affect the which may affect the which may affect the sales, right? This may affect the sales. Now suggest two ways. Point number D. They are saying suggest two ways apart from stop selling on credit in which Adil could reduce the risk of bad debts. This is stop selling on credit. We understand, but you have to give two more ways how you can reduce the risk of bad debts. Bad debts or irrecoverable debt is the same thing. Previous name is bad debts. Current name is irrecoverable debt. So you are suggest two ways apart from stop selling on credit in which Adil could reduce the risk. So you may please pause the video, think of two reasons, then again play it. Okay, come back. What are the two ways in which Adil could reduce the risk of bad debt? So can I say if you want to reduce the risk of irrecoverable debt, you can allow the cash discounts so that they can promote themselves to pay early because they are getting some advantage benefit, right? So cash discounts, allow cash discounts to credit customer for timely payment, for timely payment. So they get motivation of cash discount. They may give you on due time, and that will reduce the risk of irrecoverable debt. Again, point number 2, if some customer does not pay within the due time, charge interest on them. So they will promote to pay on timely. So as a business, you can charge interest on overdue, charge interest on overdue amount, charge interest on overdue amount, so that they will get promoted to pay early. So these are two ways: either allow cash discount so that they will pay early, or charge interest on overdue if they pay late. Point number E. Adil has maintained a provision for doubtful debt for many years. That means they are making allowances for irrecoverable debt. Estimation is making every year. He provided the following information: trade receivable on 31st August 2017. Can I say it is 1st September 2017 opening balance of trade receivable? And trade receivable on 31st August 2018 after writing of Mahindra's account. So can I say this is revised to trade receivable given to me? If this Mahindra account is not given, if this irrecoverable debt not written off, then we have to calculate revised trade receivable for calculating closing allowances. But this is we have already adjusted Mahindra's account. So can I say this is already the revised trade receivable is given? On 31st August 2018, Adil decided to reduce the rate of provision for doubtful debt from 3% to 2.5. So can I say on opening trade receivable, I will create allowances for 3%, and on closing trade receivable, I have to prepare on 2.5%. Required. Prepare the provision for doubtful debt, also known as allowances for irrecoverable debt. One and the same thing. है ना? I have used both the terminology for your understanding. Don't get confused in exam. They can either give you provision for doubtful debt or allowances for irrecoverable debt. One and the same thing. Account for the year ended 31st August 2018. Balance the account to bring down the balance on 1st September 2018. Okay. So what is the opening allowances on 31st August? So can I say 1st September 2017? I have to write opening balance here. Balance brought down. Balance brought down. How much? 44,200. multiply by opening allowances is 3%. So please calculate, guys, how much allowances for irrecoverable debt come. 44,200 multiply by 3%, it gives me $1326, right? And closing allowance is based on 42,000 multiplied by 2.5. So closing allowance will come on the debit side. So can I say on 30th, sorry, on 31st August, on 31st August 2018, I have to write what? Balance carried down. And this is based on further irrecoverable debt after deducting further irrecoverable debt. But this adjustment has already been given. So 42,000 multiplied by 2.5%. So 42,000 multiplied by 2.5%. So let us check how much 42,000 multiplied by 2.5%, 1050. So can I say which side is higher, guys? Which side is higher? Obviously, my credit side is higher. So can I say the allowances for irrecoverable debt is reducing? In the example, it was increasing, but in this question, it is decreasing. So 1326 minus 1050. So 1326 minus 1050. So 276 is my income, and it will go to statement of profit and loss. So this is called as decrease in allowances for irrecoverable debt. So this is it, guys. This is your question for irrecoverable debt. I hope you understand the concept. If you want more such videos, please let me know. Please like, share, and subscribe this channel for getting more and more videos on the topic. Till then, thank you so much. Good evening. Enjoy the study. Put your efforts, and if you need my help, please let me know. Please put your comments in the comment box on the YouTube channel. Thank you so much. Bye bye.